All right, joining us now with his take on the markets, Wall Street veteran Chuck Clough, the man, the myth, the legend. He's chairman and chief investment officer of Clough Capital. Was one of the few, select few, to accurately call the dot-com bubble. One of my colleagues at Merrill Lynch in the 80s. You've been in the business 59 years.
It's a good number. That's
Me,
all right.
45. And in my office, people knew, but I mean, they were all screaming Eagles in my office. Jack Joyce, Jerry, all Boston College guys. That's why you were revered. I think on One Beacon Street office, and
it was a good office.
You had a great run at Merrill, I think till 1999, and the run continues. But you're never on TV.
No, I haven't been. No.
I don't know. And your ETFs are killing it too.
They're doing great. They're doing well. Yeah.
Well, let's talk. Since we said that you correctly called the dot-com bubble, you'd be good at calling this bubble. You don't think it's a bubble.
No, not in the traditional sense. So people always think they're going to relive a recent experience, and the market always has something else in mind.
It barely rhymes.
Yeah, it does. It does. I think there are a lot of market and economic pressures on short-term interest rates. The market wants interest rates to be lower. If we didn't have a Fed, if the Fed wasn't there, short rates would be between 1% and 2%.
And you think that's your greatest call, was the secular decline in interest rates?
In interest rates, yeah. I made an entire career, Joe, on one call, and it went away for a while, but now I think it's back. There are three reasons. One is, in fact, if you look at just what the capital markets are telling you, look, the Fed cut the size of its balance sheet by a third, and the S&P is up 2,000 basis points. If you remember, an awful lot of high-yield bond funds raised hundreds of billions of dollars in the late teens, and they'd starved in the teens. The interest rates were never more than 2%, and they never deployed that money. Spreads never widened out. BBB minus spreads never got above 100 basis points, not for a long period of time, and they're 93 today. And then third, the dollar's supposed to crash, and it's not. It's sort of trading in the middle of its range for the last 10 years, and up a third of its range for the last 30 years.
It's very orderly.
I think there are three. The question is, interest rates and inflation went down for 40 years. Then, of course, COVID upended the whole thing. The question is, why did that happen? What are the reasons, and have those reasons changed? And I would argue there are three reasons, and they really haven't changed. In fact, they become more deflationary as we go into the 30s. The first, the most important, is demographics. Demographics are probably the strongest reason why the yield curve is where it is. For a simple reason: as societies age, they save more. People are concerned that baby boomers, as they retire, will cut the labor force, and interest rates will shoot upward because of labor costs, and that leaves out part of the equation. When you retire, you stop spending. You don't buy houses. You don't buy cars. Older populations save more. Japan's the best example of that. In fact, if you look at Germany, Japan's been, I don't think the JGB's seen positive interest rates for 30 years. In the case of Germany, in about 2013, about the time of the Greek debt crisis, Germany's savings began to exceed investment, and the Bund hasn't had positive interest rates. Italy's economy is no higher than it was, no larger than it was in 1999. Yeah. And Germany's been actually contracting. Well, we're at that point right now. And that sets up a number of important things. One is, right now there are $170 trillion of financial assets in the United States, and the economy is $30 trillion. And it takes a lot of huffing and puffing for a $30 trillion economy to sustain high interest rates on $170 trillion of financial assets. And the point is that if interest rates start to rise, defaults start to emerge. And we're in a fractionalized banking system, so defaults stop credit. And that's kind of where we are right now. Now, I think the reason why I say that affects short-term interest rates is that what the short-term interest rate is, the deposit rate, it's basically the price of financial sector liabilities. It's the price of a deposit or commercial paper or something like that. And if you're in a contractionary debt period, the financial sector is going to shrink. It's going to become smaller, and we're already beginning to see that. Banking consolidation. If you start to liquidate your liabilities, the price of a financial sector liability will decline. Now, if you look at the debt stock, people forget government debt is higher as a percent of GDP, but private debt, which is a larger aggregate, Government debt's maybe 37 trillion, private debt's roughly 50. But that's contracting. Household debt now is contracting at 2 percentage points a year relative to GDP. And business debt is contracting also at 2% a year. And I think that's really the story. As debt contracts, it's hard for the banking system to move. It's already liquidated 10% of its deposits. And I think that's a story that will start to unfold as we go through.
And that will mean what?
Bullish, yeah. Bullish on stocks, I would say.
Well, it is positive for stocks.
And productivity and everything else.
It says bond yields aren't going to be high enough that it really creates a tremendous opportunity. But, you know, two gentlemen won a Nobel Prize in economic sciences. Merton Miller from the University of Chicago,
right,
and Franco Modigliani from MIT. And they came up with an incentive or an observation that I think describes the markets today. They said you can't change the value of the firm by changing the debt-to-equity ratio. If debt goes up, equity values go down. If debt goes down, equity values go up. And that's kind of what's happening today. I think what you're going to see is a massive shift in the ownership of the corporate sector from the debt holder to the shareholder. As that comes out, the cruise line industry is an excellent example of this. They were forced to leverage their balance sheet heavily during the close-down period. Now, as they liquidate it, the value of the equity is going to rise. And that's where the equity market is today. I think it benefits enormously as this debt stock begins to unwind. Equities clearly benefit, and that's really the story for this.
One of the problems with the dot-com bubble was so fragmented, so many different companies. And it was, I think, something you call eyeball. That you were
right.
The promise of the future.
Not revenues, eyeball.
Eyeball. Yeah. And now you've got 4 or 5 companies that are real, and they got money, and they're leading the way. And there's actually result. It's underpinned by actual financial performance, but the end result, as powerful as the technology is, could be the same, but you don't have to go through sort of the growing pains maybe of the dot-com bubble.
Well, the entire corporate sector is generating free cash flow. And that's never happened before late in the cycle.
But you don't think, and the productivity gains from AI are going to also be?
Well, I'll tell you what's already happened. If you look at hours worked, best way of measuring labor time, they're down about 2% from 2019, before COVID hit. Real GDP is up 13%. That's a tremendous productivity gain. And right. we haven't even seen the real effect of AI yet.
Right.
I mean, so remember, productivity is profits. So,
and you don't think that AI could be a double-edged sword? Because sometimes I think to myself, you know, we're all talking about, is there an AI bubble and it turns the wrong way? Then I think to myself, well, in success, it could also turn the wrong way. Insofar as if we have a productivity boom, what does that mean? It means more growth at lower costs. Where do you get the costs? Look around the table here.
That's us. Well, I think the beauty of a democratic capitalist system is you always find something else to do.
Right.
And that's happened throughout history. Remember, agriculture was 48% of the economy at the turn of the century, and it was 4% coming out of the century. So I'm not worried. I am worried about the labor force. It will have an effect, and we're obviously beginning to see a political snapback on that. But I don't think that's going to stop the dynamic that we're seeing right now. Now, when you look at the hyperscalers, I'm not sure anybody's going to make money because you're a hyperscaler. But as a hyperscaler, you have the advantage that the 2 companies that had the operating system, there are only a handful of companies that survived the dot-com boom to become even larger enterprises. Apple and Microsoft were 2. And the reason is they had the operating system, the way you access the internet. So they created the software that allowed everybody to do that at almost no cost. Remember Netscape? How Microsoft ended that situation in 6 months. And I think that's the situation today with the hyperscalers. They may not make money on the large language model, but they'll throw out software packages at very low costs, and that's why they're so powerful.